Hello, welcome to this video demonstrating how to reformat an income statement. In this Excel sheet here, I've got the income statement for Australian Vintage Limited. I've entered in all the data into the income statement here directly from the financial reports for Australian Vintage. So as you can see on the Australian Vintage statement of profit and loss here, in 2020, they've recorded a net profit for the year of $10,953. And for 2020, I've got a net profit of $10,953. They also then record a little bit of comprehensive income to receive in total a comprehensive income for the year of $13,252, which we've got in the spreadsheet. So once I've got my income statement entered into the Excel spreadsheet, I can then start the process of reformatting the income statement. So the income statement reformatting process is a little bit more tricky than the balance sheet. It's not hard, there's just one extra step where sometimes we might make a mistake. So let's go through reformatting the income statement. First of all, I want to show you the end goal, what it's going to look like when we're done. So with the reformatted income statement here, I've got my operating revenues and operating expenses listed, and I then calculate net operating profit before tax. I then minus off the tax expense and get a net operating profit after tax, which we call NOPAT. In this section here, I deal with the financing activities of the business. I've got the financing revenue and financing expenses. I then deal with the tax implications and calculate net financial expense after tax. I then say my NOPAT, net operating profit after tax, minus the net financial expense after tax, gives me the overall net profit. Take into account some comprehensive income, and I can calculate the overall comprehensive income. And then I can check that the numbers that I've got from my income statement that I've just entered in straight from the report, comprehensive income of 13,252 is the same as after I've reformatted it. So my net profit is equal to NOPAT minus NFEAT, add in the comprehensive income, and my comprehensive income still balances. So the reformatted income statement still has the overall same profit, whether it's net profit or comprehensive income. We're not changing any of the numbers. We're just reclassifying and reformatting where the numbers belong. Okay, so when we're reformatting the income statement, something that's really important to remember is we're going to start with the financing activities. So this section of our reformatted income statement is what I'll actually create first. So let's look at my income statement. I go through every account and I decide if the account is an operating or financing account. So something like sales revenue, that's part of our operation, so I'll call that operating. Other income, I'll have to go and look at those other income accounts in the notes to the financial statements and figure out whether they're related to financing or operating activity. So it requires us to check the notes to the statement and make a decision based on the information given. Then I look down at the different expenses, cost of sales, that's going to be part of operation. Fair value loss on grapes picked, that's part of our operations. Distribution, sales, marketing, admin, these are all operating expenses. Then we get to finance costs. Well, finance costs are probably going to be financing activities. These are the costs of your interest and setting up loans and all those kind of things. So this number is likely going to end up in the financing activities. So let's look at the reformatted income statement that I've prepared. I've put my operating revenues up top, then I've got my operating expenses. But I said what we need to do when we're preparing this is start down here with the financing section. So the financing revenue. In 2020, I said interest income is stated in note 3. So I actually had to look at the notes to the financial statement. For the revenue, cost of sales, gross profit, and other income, it all says check out note 3. So when I saw this other income number, I was like, okay, I need to know what is this other income. So I had to go check note 3. So here I've loaded up note 3, which is for revenues and expenses, and they talk about their accounting policy for revenues, and they give us a breakdown of the different revenues down here. So the other income that they declared in 2020 was $1,822, and they've broken it up into the different types of income. And here, the one of interest for me, I'm trying to figure out what's financing and what's operating. Interest is associated with financing activities, so I found interest income of 26, so I've classified that as a finance revenue or a finance income. So when I look at my reformatted income statement here, I've put financing revenue of 26 in 2020, and I've said it's from note 3. Then I've looked at the financing expenses, which are also given in note 3. Okay, so as part of note 3 here, section E, they've given finance costs, and they've actually told me the interest expense and the unwinding of discounts. So I've used this total amount as part of my financing costs here as per note 3. So in my reformatted income statement, my financing expense, I've got 3,682. 3,682 as financing expenses. Okay, so now I know my financing revenues and I know my financing expenses. I can calculate what's called net financial expense, or we could call that just NFE, and it's equal to my net financing expenses, my finance expenses minus my financing revenue. This is the amount of money the business has spent on financing its operations. So the net position means we're taking the financing expenses minus the financing revenues to get a net position. This is how much of a loss that we've actually made from borrowing money and having to pay the interest. Because we're making a loss and it lowers our profit by 3,656, that reduces the amount of tax that we have to pay. And that reduction in tax due to financing our business with debt is called a tax shield or a tax shelter. So this number here, the tax shield, needs to be calculated. And to calculate the tax shield, we use the Australian tax rate, which is 30%, and we multiply our net finance expense by the 30% tax rate. And what this number here tells me, the 1,096, it's saying that because we have used debt and because we have made a loss from the interest, or we've got this tax deductible interest expense, it has lowered our tax bill by 1,096. It's a tax shield or a tax benefit because it's lowering the amount of tax we have to pay. So we now calculate NFEAT, net financial expense after tax. Net financial expense minus the tax shield gives us net financial expense after tax. So we're now finished with our financing activities. We did it first because this tax shield number needed to be calculated. And I've highlighted a cell up here also in green, which is the tax shield. So I've calculated the tax shield here, but then I have to use that number up here when I'm doing the operating section as well. Okay, so that's why I've done the financing part first. So let's look at our operating activities on the income statement here. I've listed my revenues here, and then I've got all my operating expenses, and I calculate operating profit before tax. I added up my revenues minus all the different operating expenses. When I look at my income statement, I see that I've got an income tax expense of 4,564. When I reformat my income statement, I have to realize, okay, this income tax expense of 4,564 is how much I actually have to pay the tax office eventually. But my operations may have generated more tax expense than that, but because my financing activities were running at a loss and decreased the amount of tax I have to pay, when I decide, is income tax operating or financing, I realize it's driven by both my operational and financing activities. So I need to split this number into two components, the tax due to operations and the tax due to financing. And we can do that pretty simply here. The tax expense was 4,564 in total. However, we had a tax shield of 1,096, which was calculated here due to us using debt, which lowered our tax. So our tax on operations would have been 5,660 if we didn't have this tax shield. Okay, so my tax on operations is the tax expense that's given in the income statement plus the tax shield. And that would be the tax I would have had to pay on my operations if I didn't have this tax deduction from using debt and having interest expense. So I can now calculate NOPAT, my net operating profit after tax. Net operating profit before tax minus the tax on operations that I've just calculated gives me NOPAT. I can then check that I haven't made any mistakes. Net profit equals NOPAT minus NFEAT. I go back and I look at my income statement. For 2020, my net profit after tax should be 10,953. I've calculated it as 10,953, so I haven't made any obvious mistakes here. So let's recap what we just did. We have reformatted the income statement. We've separated out the operating activities up here. These are all my operating revenues and operating expenses. I've adjusted the tax expense to take into account the tax shield, and I've calculated the tax on operations. I've also calculated the financing activities of the business, the financing revenues minus the financing expenses to get the net financial expense. Then I've taken into account the tax shield to get my net financial expense after tax. My profit hasn't changed. I've just reclassified where different accounts go. So we've now finished completing the reformatted income statement. The next thing you need to do is check out your free cash flow calculations. So there's two ways we can calculate free cash flow here. We've got two different formulas. Free cash flow equals NOPAT minus change in NOA plus other comprehensive income, or free cash flow equals net financial expense after tax minus changes in NFO, net financial obligations, plus dividends minus changes in other outside interests. So what I've done up here, opening equity in 2020. My opening equity in 2020 would be my closing equity in 2019. So I've referenced the cell here, D44. My 2019 closing equity balance would be the 2020 opening equity balance. My comprehensive income, I've got this straight from my income statement or my reformatted income statement. I've got the comprehensive income number in both. Here, I've had to calculate the dividend or net payments to shareholders, and we can check the statement of changes in equity to do that. So here I have the 2020 statement of changes in equity. It tells me my opening equity balance. Now, this is a little bit of a trickier one. Because there was an adoption of a new accounting standard, that equity balance has changed. So there's this extra adjustment to equity that we need to pop into our formula as well. So we have a slightly different opening balance after it's been restated due to this accounting regulation change. We then have our comprehensive income for the period and transactions with owners in their capacity as owners. We get we can calculate the D or the payments to shareholders from these balances here. And then we end up at our ending equity balance for the end of 2020. Okay, so we've calculated it here. When I look at the formula, my only difference is I've adjusted for this change in accounting standards in 2020, but in 2019, we just used the normal formula to calculate dividends. Our opening equity plus comprehensive income minus the closing equity would calculate out the net payments to shareholders for us. When we do the free cash flow calculation now, we can do NOPAT minus changes in NOA. I've got NOPAT from my reformatted income statement. Changes in NOA refers to the current 2020 NOA minus 2019 NOA to see how we've invested in our operating assets during the year, plus other comprehensive income, which we've got listed here in our reformatted income statement or in our normal income statement. Okay, and it gives us our free cash flow for each year. Next line, we're doing it a slightly different way via the financing activities, net financial expense after tax from the reformatted income statement, changes in NFO from our reformatted balance sheet, plus D, the dividends, which we have just calculated up here, minus changes in ownership interest, we need to make sure that these free cash flow numbers balance out. Both methods will give us the same answer. If they don't, it means we've got a mistake somewhere. And I've taken some information from the cash flow statement, cash flow from operations and interest and other taxes for future weeks when we're going to look at ratios as well. So what we've done now, we've entered in information from the balance sheet and income statement into Excel. We have then reformatted our balance sheet and our income statement. And using the information we've got, we've been able to also calculate the free cash flow using two different ways and check that it all balances out. So now we've got all this information together. Next up, we'll be able to use it to calculate ratios and start to get a good understanding of the drivers of business performance. Thank you.